But if you're just getting started with Power Options, I encourage you to take advantage of the 4 steps here. You can access that free start guide. There's a variety of flash tutorials available to help you get more familiar with the tools on the site. We have a variety of different archived webinars and live webinars that you can join us during the month. You can click the free webinars tab here at any time to go through our archive on Power Options tools, option strategies. Of course, all our Friday sessions are archived there as well. And when you're ready, or just at any time, we encourage you to take advantage of the free coaching session. It's not a sales call. This is essentially a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site, answer any questions that you have about the tools, or of course about option strategies, as we're likely going to cover some things today as well. I had about 7 coaching sessions this week, I believe. One of them actually lasted an hour and 10 minutes. So we're flexible with the time. You have a scheduled hour time to talk with myself or Ernie. If it goes shorter than that, fine. If it goes longer than that, that's usually fine as well. All right. Well, I think I've got everything I need here for the first couple of questions that came in. Let's see, long put, long call. I took off. No, I do have bull put credit as well. Okay. So Jim's first question comes in, and Jim says, is there a way to see option buy opportunities with high option volume? Absolutely. So anytime I want to look at a search in a given strategy, we just click on the specific strategy tab, and I can navigate with the submenus here without actually going to the long call home menu, but we can go right into the main search screen. Okay, our search tool for a given strategy, as you mentioned, searches across the universe of options, finds only those positions that match the specific criteria. Down below, we have some defaults already created for you to use as a stepping stone. This one's based on Bollinger Band breakouts, which Ernie researched the Bollinger Band breakout patterns and the criteria that would be successful for long call trading. We've created some other searches here during our sessions. But if I wanted to see a high option volume, let me go back. In any search for any strategy, you'll have 4 sections. Your options criteria, you can set range in or out of the money, IV ratios, time to expiration, I should have said in or out of the money, strike price, Black-Scholes ratios, minimum bid, minimum ask, and more. Then you can set your technicals for the stock, your fundamentals, or just screen against a specific stock list or create your own stock list as well. Now, for Jim's questions on high option volume, one of the filters that's available for most option strategies is the percent current option volume and the percent previous option volume. Now, the percent current volume shows you today's total option volume for the stock, not just a particular strike, but the entire stock, all expirations, all strike prices, compared to the average over the last 30 days. So when you think about looking for high volume, naturally a single strike, let's just say the May 45 strike on a particular stock, might suddenly have 10 contracts traded. And its average might be 1. So you can say, oh, that's the 1,000% increase. But that just means one person is taking a bet on those 10 contracts. What you really want to see is activity across the board. Increased activity on all strikes compared to the average of all strikes, where the activity, the action is really going. So on this filter, at 100% means the total option volume for the stock is equal to the average over the last 30 days. So if I wanted to see something that's really moving, I might want to look for a current option volume today of 200%. And of course, I might look for even a minimum of, let's say, 20, 50, or 100 contracts, actual option volume today, maybe an open interest of 100. But higher volume, higher open interest, but in general, I want to see total current option volume as a percentage. Let's see if anything comes up with our other criteria. Makes sense, doesn't it? Bank of America. Banks had great earnings coming out in the past 48 hours. They had a big boost today. You can see that up 110. Makes sense that a lot of activity is going into the banks there. Walt Disney, they just, of course, announced their new streaming service to sort of compete with Netflix or not. So they saw a lot of option activity. And of course, you can see a 10% jump today. Actually, it's more than that. It's probably at about 117 this morning, up about 14 points to 130.50. And of course, the financial sector, again, all the banks reporting good earnings, very strong. There we go. So that's where we saw the activity today. And you would have seen this when you ran the search as well. Disney, Bank of America, and XLF. So just use that percent current option volume, and you can increase it higher. You could put it up to 300. Let's just see. Was any of those 3 or 4 up to 300% option volume? Okay, Walt Disney was, of course. That makes a lot of sense. I don't know these two. Whenever you see a stock come up in the search, but you don't know the criteria, I'm sorry, you don't know the stock, remember, just go into that company information and news. You can take a look at the profile, recent earnings events, indicators, and a lot more. You can also just go to the basic research page for the stock research, and we'll show you all the information we have as far as raw data goes. But I don't know Rollins. I'd go ahead and take a look at the profile, see what sector and industry they're in. I could also add those columns directly up here in any search also. Okay, Jim, so that's what you want to look for when you're considering looking for higher option volume, that percent current option volume field, or even the percent previous option volume, looking for where the activity is across the board in the positions. Okay, interesting question here. Deni says, when I've tried, oh, sorry, in the middle of your question, Deni, I started in medias res, I apologize. Deni says, hi, I want to learn how to hedge a long call. When I've tried to sell a similar put, Thinkorswim says my trade is infinite risk and I chicken out. Thanks for your help. Okay, it does have infinite risk. Selling a put, a deep out of the money put against a long call, is going to create a hedge for your position, similar to what a covered call would do on a stock position, if you look at it that way. But what does a covered call do on the stock? It caps the upside, and so let's say you generated 3% premium on your covered call, Deni, you're still taking 97% of the total risk of owning the stock. You only hedged it by 3%. You're not expecting your stock to fall 3%, obviously, but things happen. Let's go to the custom spread tool. All right, and we'll take a look. Let's just use Disney as an example. And let's say the other day, when the stock was around 116, 115, we bought a May 120 call for $2. All right, so this is going to look fantastic. Actually, let's just say now we want to jump in because we saw that high activity, we just saw. Let's go more than 35 days. Let's hit June. Let's hit 70 days. I like to go at least maybe 70, 75 days out of time, maybe up to 120 days on my long calls, even though the cost is higher. Yes, you can kind of make money with weekly long calls if you're right, but you also have a faster time decay. So going further out in time, you have a much slower time decay on your position, and you still have the potential for outsourced gains. Let's say we think Disney's going to continue this run. We're going to go slightly in the money, not a bad price. The 125 at about 865 or so. Okay, so that's our long call position. Let's keep the math simple. Buy one contract. All right. Sorry about that, folks. So here's our profit and loss of our long call position. We know our break even's up at 133.62. Strike price of our call 125 plus that 862 premium at midpoint. Now, let's sell an out of the money near term put, maybe even in April, say a 120 or a 115. Okay. Let's go to standard 6 days out. Let's see what the 120 or 115 put would look like. 15 to 17 cents. After this large run, it might be a pullback. So we're going to skip April. Let's go at least 20 days out in time. Let's go to May 3rd weekly. 37, 40 cents or so. Not great, but not terrible. But let's just sell the out of the money put to give us a little bit of downside protection. It's about 5%, right? 40 cents against $8, a little bit less than 5%. Okay, so let's just put in 40 cents there. Now, did you leave the upside on your position open? Yes, you did. Did you hedge the cost of the position? This might not be the type of structure you're looking for, but yes, you hedged it by 40 cents for the next 20 or so days. 100% risk, what are they referring to? Remember, This is the naked put now against your long call. The long call gives you the right but not obligation to buy shares of stock. The naked put gives you the obligation to buy shares of stock if it's below 120 at any time between expiration. You're not in control. The put buyer is. Okay? So, what this essentially means is that you have an obligation to buy 100 shares of stock at $120 if the stock's trading below there. Your broker wants you to cover that margin, of course. And if you're trading a 50-cent margin, you have to put up $6,823. The risk is infinite, as is the profit, but the risk is infinite in the sense to that lower value. If Disney went bankrupt, right. But if Disney went bankrupt, you'd be on the hook for the $12,823. Your call would expire worthless. You'd be forced to buy shares of Disney at $120 that are trading at 5 cents per share. That's what I think they mean by infinite risk. It's not like a naked call. We have infinite risk to the upside because the stock could technically go up to infinity. If you ever find the stock, Deni, that goes up to infinity, give me a call and let me know. I want to jump in on it. However, that's what they're referring to. The long call does not cover the obligation of a naked put. What you might consider doing, and it depends on your hedge, it depends on your goals, I should say, not your hedge, but your goals. Instead of just the naked put to generate some premium, maybe what we want to consider is going further out in time. So I'm out 70 days to June. I don't know your structure, Deni. You might be out only a month, and that's fine. You heard me say why I like to buy my long calls. That doesn't suit everyone's goals and needs. That's fine. But let's go about halfway out. Let's go to May 17th, standard expiration, 35 days away. I want to get some good premium. Now, I'm bullish on Disney. So let me sell a 125 for about 198. I'm going to go with the 115 at about 50 cents. Let's call it $2.50. Instead of just selling the put, we're going to enter a bull put credit spread. Sell one contract and buy one. And I'm just going to put in the price here, $2 and then 50 cents. We're getting $1.50 net credit on a 10-point bull put spread. By itself, we're looking at about an 18% return. But what you're doing is hedging this long call now by $1.50. But because you're in a bull put credit spread, your max risk is only $17.13. Now, it didn't go all the way, so let me get a better pen color here for us. It's going to be the light blue color. And what we'd see here at 115 is now this falls off. So right about that $1,713, you can't lose more than that. Even if the stock fell to $100 per share, what would happen? The call would expire. If you didn't close the bull put, you'd be forced to buy shares of stock at 125. But you have the right to sell them at 115. So yes, you take a 10-point loss on the bull put credit spread, plus the 863 you invested in the original position, the original long call, 862 or 863, okay, minus our $1.50 net credit, which puts us where? $1,713, still with the infinite upside. So this is one workaround, Deni, that you could hedge your position if you're looking at puts, selling an OTM bull put spread against your long call. That covers the infinite risk to the downside. And again, why did you have infinite risk to the downside when you were trying to sell your out-of-the-money put against your long call for a little extra premium? It's because it's a naked call. The long call does not cover the obligation of the short put. If the stock falls, you're going to be obligated to buy shares of stock at that price. If it falls 30%, you'll probably get put the stock early. The call is worthless. You've got a 30% loss on the long stock. It's going to take you a while. In this case, if the stock drops 30%, maybe down to $97, the worst you could lose is $1,713. You've hedged your long call with the bull put, and you've left the upside open. That's one way, an out-of-the-money bull put spread. Okay. Sam joined the party a little bit late here. I'm going to get to Sam's other comments in a moment. Sam says you can protect the long call by buying a straddle. Now that's true. But Deni's original question, Sam, was a concern of he was trying to enter a put, sell a put against his long call to hedge the position, to hedge his long call. He was selling a put to hedge the long call. So he wanted to generate premium. So I want to cover the two ways I would generate premium first, and then we'll see what a straddle looks like on the inside of this as well. And I think Fernando just jumped right onto it. So they're all sneaking in, Deni, with the little thoughts of where I'm going. The next thought is, we have just a long call. Sort of simulating stock ownership. We want the stock to move up, but we want to use leverage. And the first idea is, well, how do you hedge a long stock? You can sell a call against it. Well, we talked about that. If I generate 3% on my covered call, what have I done? I've capped the upside on a stock I was expecting to move up 10, 15, 20%. But at the same time, I still have 97% of the risk I had on the stock initially. I only generated 3% against it. Now, I'm out to June. I'm sorry, I said July earlier, but I'm out to June, 70 days. Generate some income is a different hedge to sell again a 28, 21 day call against it. Let's go to May 3rd this time. See if there's any premium. Oh, they haven't released the new strikes yet because it moves so fast. Well, maybe. Okay. Let's go to standard expiration. Let's go to May. Yeah, we've got a couple more here. So we could generate 135 might be considered a little bit close. So let's go ahead and sell the 135 call anyway. Closer than we want. Let's sell that for 225. What did we just do? We created a calendar spread where we knocked down the price of our long call by about a fourth, 25%, a little bit more. So we still have a high maximum return in this case. But with all the talk on Disney and everything that happened today, you might be expecting it to go further. And Disney's not necessarily as a stock, and we're just talking about this. Well, how about instead of just selling a call, what can we do to leave the upside open? If we expect it to go 140, 145, 150, we've capped the upside gain. This hedge didn't really do us much good for our goals on the position. Still 74% return. It's nothing to bat an eye out, but that's the maximum if it's trading right at 135 on May expiration. What if we add another call to this? By adding another call, essentially what we're doing here, Deni, is we're creating a bear call credit spread. And I'm going to go cheap. I'm going to go up to 145 for 45 cents. We're still going to keep about 180 or so, a little bit more than that, a little bit less than that, about 190. But we're going to buy a call. What's that? Selling a 135, buying the 145. That puts us in a bear call credit spread. Now, we still do have this plateau here, but you keep the infinite upside. Why? Your broker looks at this as one of two ways. And you can say, oh, well, you're going to have to put up the monetary cost, this extra 10 points, for the bear call credit spread. Remember, I sold a 135, I bought a 145. Sorry for the jaggedness there. Here's my 145 strike, here's my 135. Say, well, that's a credit spread, great. I gained $1.90 on this bear call spread to reduce the cost basis on my long call, but I've got to put up the 10 points here to cover this bear spread. No, you don't. Why? It's still done at a debit. Your broker sees this as a debit spread from our original 130 call to the 135 sold, and then we just bought an extra call to leave the upside open. So now you've hedged your loss again, well, from 860 down to 679. This is still about 210, so it's probably about 20%, a little bit more. And you leave the upside open. You still have a reasonably strong profit here at the plateau as well. So that's an out-of-the-money bear call spread added to your long call, which won't require any monetary requirement because your broker hopefully should read this as just a bull call debit spread, 130, sold the 135, you've got an extra 145 call lying out there as well. Okay? So that's the second hedge that you could use on the position to generate premium, lower the cost, and leave the upside open. Rather than selling the naked put, do an out-of-the-money bull put spread, which will, by the way, require you to cover the difference in strike prices. Okay, that won't cancel the obligation of the short put. So if it's a 10-point spread, you'd have to put up 10 points per contract to cover the obligation. As long as the stock stays the same or moves up, everything expires worthless. You hedge the cost. What we're looking at here, number 2, is the OTM bear call credit spread, where you likely won't have to put up any any margin requirement, because they'll likely see it as a debit spread with your initial long call or a calendar spread, and then you add the extra long call. You don't have to put up the difference between the strike prices, hopefully. You could also enter them differently in the sense of selling the call first to create the calendar so they see it as the debit spread or the diagonal spread immediately, so you don't have to put up any requirement, and then just adding the long call. It'd be an extra commission, but that's what you could do. Sam's thought was you could potentially do both, but it would require the margin. Sam said a straddle, meaning buying a call and buying a put. So you could hedge the loss on the long call by buying a put as well. But of course, if you're doing proper position sizing, the number of contracts you bought for the long call should be representing a smaller portion of your portfolio anyway, so you're willing to withstand the full loss. If there was a 15 to 20% pullback on the position, you'd know you'd have a 70 to 80% loss on the call. So you'd only want that to, Sam says 2% with a long call. Yeah, 2 to 3%, maybe 4% if your total portfolio max, but I would tend to stay in that 2% range also. Okay. And as Fernando mentions, that bear call spread added, selling the 135, buying the 145, that's similar to what we call income method number 6, the bear call spread that we use in the married put and the radioactive positions as well. So those are the two ways. We might come back to that straddle or strangle on the position. Sam, I'm just going back through your previous comments. Yeah, protect with a straddle. Okay, so yeah, good afternoon, Sam. Now that we're going through that, so did not trade, not my type of market. You needed more volatility. Yeah, so I had a small loss on my VIX calls. They didn't do as much as I wanted to, so I closed those out, I believe, last week, and I doubled down on the VIX calls today when it dropped down about 12.25. Oh, okay. APC was also up 30% today, he says, for a takeover. I didn't see that one. Okay. So, again, Deni, real fast. Instead of trying to use the naked put to hedge your position, consider the bull put spread. You could also do that bear call spread we just showed. With this profit and loss chart, leaves the upside open, and you don't have to put up any margin requirement. What Sam was mentioning is you could convert this to a straddle, of course, buying a cheaper, shorter term put, let's just say the 120, and then you may also buy a cheap out of the money 145 call as well. So you've got your long call already in position. You add the strangle here. What does that do? Well, it increases your cost, but it keeps your max risk about the same. All right, so out of pocket, we now have 1,008 instead of the 862 from our original call option. But what does the strangle do? Well, it still caps the downside here in this position. And look, if the stock's trading right at 120, that's your maximum risk. What happens if the stock continues to fall? Well, this starts to move back up in price. Okay, so you've got the strangle here with the 145, 120 out of the money, and still your 125 call. So you leave the upside open. You've got a small protection. The max loss occurs down here. This isn't generating premium to hedge. This is adding an insurance policy, which you could do by just buying the 120 put, but then doubling down with a second cheap call to sort of help hedge the delta on this side if it continues up. Because with just the 1-to-1, it's not a bad idea either, right? Just buying the 120 put to create the strangle in itself is not a bad idea, but you've lowered the return, meaning that as this moves up, this delta here it's getting lower and lower on that 120 put, but it's still countering the delta gain you're getting in the long call. So if you added an extra long call, as we saw, that sort of helps with the delta performance, putting a strangle on top of a long call rather than just buying an extra put to create a strangle in itself. All right, and from based on what we just saw, this leads us into Jack's question, what Fernando pointed out as well. So Jack's question is, how would you protect a long-term stock position in JPM and still generate income on the position? Well, Jack, if you haven't done so, I'm going to encourage you to check out information at radioactivetrading.com. It's another site that we run, but we're going to review why. The best protection is a married put. The best structure of the married put is following the radioactive trading techniques we discuss in the blueprint. So yes, married put is simple. Hey, I buy a stock and I buy a put option, and a lot of places say, hey, if you own JP Morgan at, let's say, I don't even know where JP Morgan is. Let's take a look real quick. I'll go back to that in a second. All right, so you own JP Morgan, let's say, let's give you a nice good price of $98. It's up 5 points today, so you still had a small gain and it jumped again today. Now you say, hey, I want to protect it. Okay, well, a lot of free articles out there, Jack, will tell you that the best way, and one of the ways to do a married put is the stock's at 111 right now. Hey, why not buy a cheap 100 put for 3 weeks out, 30 days out, or May expiration and only pay 85 cents? Well, that's great and all, but what does that do? That only protects you for 35 days. At the end of those 35 days, the stock's still going up, that put expires. Now you've got to buy another, let's say, 115 put for $1.05. All right, so now you've got $2 invested in the position. What is the one static thing that we know about options, or that we should know about options? And you know what? I'm just going to use the search here. The one thing we know about options is that the option that is 3 months out in time, same strike, is not 3 times the cost. The option that is 6 months out in time is not 6 times the cost, which is why in our previous discussion I mentioned if I'm buying long calls speculating on the market, I like to go at least 70, 75 days to maybe 120 days out of time. Why? Because I have a lower cost per day. Yes, it's higher up front, but it's a lower cost per day, still the chance for leverage profit. And if I buy a weekly or 2 week out and the stock hesitates and pulls back, well, I'm going to see rapid time decay and see a large loss on that 2 week out call or 1 week out call. If I'm 75 days out, that's fine. I can take that. I've probably only lost 8 or 9% on that farther out call. And if it starts to recover, if the stock dropped 4%, I might be down 8 to 12% on the long call that's further out in time, and it recovers. I didn't have to buy another call, then buy another call, then buy another call, where I've increased the cost basis further. What we look for in our default married put structure is I want to go at least 150 days out in time, and I want to keep my risk into single digits to avoid the lie of leverage and to avoid gambler's ruin. That's, in a nutshell, the general structure. There's a lot more involved in that. But here's what we're going to do. Let me clear the settings, all the filters out. I'm going to put my expirations from 150 to 270 or so. No, I'm sorry. I wanted to show an example. My apologies. We're going to go 5 days to 210 days. Okay? And I'm going to go no more than 2 strikes in the money. Let's just go 1 to 2 strikes in the money for JP Morgan. And I want to keep the risk to be less than 8%. And all I'm going to do now is I'm going to go to the fundamentals. I'm just going to type in JP Morgan. Okay. And yeah, I need to change the sort to, I want to change it from maximum risk from lowest to highest. Oh, percent maximum risk, lowest to highest. All right. Okay, so what have I got for you? There's nothing else in here. I'm sorry, it should have given me a lot more. I'm just trying to think of this. That's not restricting it, but let me go ahead and put that up to 10. I know that's not the restriction here. Let's go out to 285. That's very strange. Okay, well, I'll use this as an example real quick. So, I know why they probably didn't release the new symbols yet. So anyway, let's take a look. Next week's expiration, 18th of April, 113 strike, 6 days away is 221. Naturally, the option at the 26th of April, which is 14 days away, is not 2 times the cost. Going to 21 days to roughly 42 days, what have we got here? May, 42 days out. May 3rd, 21 days out, 274 versus 330. Twice the amount of time, not twice the amount of cost. Okay? So, this is why I want to go further out in time. Also, at the very beginning of the presentation, we just had a quick thing here. I'm just going to transfer screens over. Give me 1 second. This is the original opening sequence, and we usually get into this from time to time. This is your standard time decay curve of an option. You see the most rapid time decay in 30 days. 60 days, it's a little bit slower, but it's still pretty rapid. And here at 90 days in 120. You might be asking me, Jack, why is that important? I just want to insure my stock. I don't care about the time decay. I don't want to pay this much price into it. The reason why you care is if in the first 30 days the stock continues up, what happens? This option's at 0. You lost all the money you paid. This option that was 120 is now 90, still has time value. You can move that put up in price for a lower cost because you're going to sell to close this, which still has time value remaining, and you can buy to open a better strike to lock in further profit as well. All right, so that's what we're looking at here. Now, the best way. How would you protect the long-term stock at JPM and still generate income? We have another little neat tool here called the insurance tool. And what the insurance tool shows us is I can put in my stock symbol, JPM. We assumed a cost basis of $98. We had a gain before the earnings day, and then it jumped up again, or everything that had the banks all jumped up today, so it's now at 111. I'm just going to put in my $98, and I can go ahead and hit calculate. Now, what this shows me is the comparison of what is my... Sorry, folks. Thank you, Thank you, guys. My apologies. Switch back. All right. So, the insurance tool. Access under the Married Put tab or the Collar tab, long collar. Just put in your stock symbol, your cost per share, and I left it at all expirations. And what this tool does for me right now is it shows me my unrealized gain of 13.5% on this position. Now again, if I could go out to May 3rd, buy the 116 put for 485, and my new cost basis would be 102.85. But I have a guaranteed exit at 116, which means I have a locked-in profit, a guaranteed profit of 13.15 and 12.8%. I'm in a bulletproof position. Only 21 days of profit. Let's take a look at what that would look like. So my cost basis of $98 per share, a 116 put 21 days out at 485, total cost in 102.85, 100 shares, 10,285, guaranteed to get 116 back. That is the worst case scenario. The worst thing I can do between now and May 3rd is profit 12.8%. Still infinite upside on the position. Okay, but what's wrong? This ends in 21 days. That might suit your goals. That's perfectly fine. The insurance tool shows you that. But now your follow-up question is, how can I generate income? Well, the same way you would generate income on a stock. I could go out 21 days, give myself some room and say, hey, let me sell that 113 call for about 92 cents. Now, what's the problem? Well, you get another hedge here to generate income. You've protected the position to lock in almost 90% of what you expected. What did you expect? You expected an unrealized profit of 113. I'm sorry, 13.5%. I'm sorry, 13.5%. You guaranteed 12.8%. Something's really wrong here. Here I have a max return of 13.8%, but whoa, that's to the downside. I still make a profit here of $1,100, but what happened to the upside? What you've done here is sort of create a bear call spread synthetically because you sold the call below the put strike price. It's probably a no-no. Didn't have enough premium to sell it at 116. But what did I just show a moment ago on a means of hedging that long call with the bear spread? Rather than just selling the 113 for 90 cents, let's buy the maybe 117. 14 cents, 13 cents at midpoint. You just did a bear call spread. Now what have you got? Let's try that again. I don't think it's submitted correctly. My apologies. There we go. Now you've got the Big Dipper position. I don't know if it still matches your needs. The best structure for this, by the way, is that if you chose the 116 put for 3rd of May, you'd be selling the 116 call, but I didn't like the premium. 18 cents, 27 cents. It would still look attractive, but again, you probably want something a little bit better. Okay, so this one wouldn't work. Now, let's go back. 116 put would have cost us $4.85 for 21 days. Okay, let me scroll down here. That's what I want to see. September. Now, what's going to happen here? The September option is going to be more expensive. You know, the 3rd of May, 21 days out, 116 is at $4.85, as I mentioned, and the 115 is at $4.10. Okay, so 21 days out in time. Let's go to September. And the 115 put is at 7.13. Okay, what's going on there? Remember, 21 days out, we were looking at $4.10 for the 115 strike. It's a little bit in the money from where we are now, about a full strike in the money. The September, which is 161 days out in time, 8 times the amount of time, is not even double the cost. It's 7.13. Is that a higher price to now where you're only guaranteed a profit of 9.4%? Yes. But that's the worst case scenario in 161 days if you do nothing between now and September expiration, accept no dividends, generate no other income, don't adjust the put if the stock moves up. The worst you can do is make 9.4%. 161 days from now. That other put, either one we looked at, the 115 or the 116, we were looking at a locked-in profit of about 13.5% or 12.8% or about 12%. Here it's only 9.4, but it's 8 times the amount of time. What does that mean? Well, right now, I've got about 7 to 8 different ways, 4 of them that I could use that could generate income and not cap the upside. I could go to that standard May expiration, sell a 115 call. It's not a lot at 73 cents, but again, these are lower priced further out. So let's buy a 125 at 10 cents. What am I doing? I'm entering a bear call spread, but remember, because I own the stock, I don't have to put up any margin. My broker sees this as a covered call with an extra long call I received at a credit, and I've got a guaranteed profit already of 9.4%. Let me enter my bear call at 115, 125. Looks a little goofy, but hey, that $1,400 profit here at 115. Still pretty close to what you would see if you didn't sell any premium. It dips back down here to 1,100, but what's that? Still an 11% profit. And you keep the infinite upside as the stock continues to move up. Do you still have an obligation to potentially deliver your shares of stock at 115? Potentially if you're assigned early. Okay, you've got the long call to cover it, but your broker might be seeing this as a covered call. But that's okay. If it goes in the money, you could just roll this as you normally would. Or if you see another sudden gap, and like Disney, this goes up to 113, we wish, but 130, but if it goes up to 130, if you let yourself be assigned, that's fine. You can buy the stock back at 125, and the profit from this transaction and the low cost from this transaction would be the same as rolling the call to avoid that position as well. Okay? Now, what happens if the stock continues to move up and you just decide to close these out, or if these expire? Well, now you've kept the premium and you've locked into a 10.1% guaranteed return, still having a put out to September, still has a lot of time value remaining on it. And if the stock was at 120 or 125 even, and we close this bear spread, we could adjust this put up. We could sell to close that 115 for the time value that remains and buy a cheaper, higher strike. So I might only pay $6 to increase my guaranteed profit by 10. This guaranteed status would jump up. My upside would be open. Although it sounds complicated, here's the trick. It's all of the information is available for you. I can do butterflies in this scenario a certain way. I could do ratio spreads in this scenario with the protected position and the proper structure. And as I mentioned, that's what's available in the blueprint. Not only starting every position off to where you can't lose more than 4 or 5%, but if you have an unrealized gain, you can use the insurance tool. What's the best put? In my opinion, going at least 5 months out of time, slightly in the money, get the lowest cost per day, best insurance policy possible so you're not buying. Think about it this way. If I bought that May 3rd 115 put for 410 and the stock moved up from where it is now, from 111, it moves up and it goes up above 115 and that expires worthless. And then I say, okay, you know what? I'm going to buy another 115 for June at only $2. Where are you? You're effectively just $1 off the original cost from already being out to September, rather than buying month by month by month. But again, that full information is located here in the blueprint, our preferred structure, the 12 different income methods or adjustments we use off of that structure to lower the initial at risk, further bulletproof the status position, and once you have a bulletproof position, generate more income. And aside from just selling the covered call, which caps the upside, there are ways that you just saw that you could leave the upside open as well. Okay, that's how you would do it. That's the best protection possible, Jack. Take a look at it. Take a look at the insurance tool this weekend. Plug in your numbers, see where you stand, and see other things as well. Okay. All right. Well, thank you for giving me an example, Fernando. That might help. Fernando's question is related to PowerOptions searches and searching for positions that have been in a decline. He said, is there a way in the PowerOptions tools to screen for stocks that have had a consistent drop in the last 90 days, as has happened for Kraft and KHC as an example? Well, no, I don't have a direct filter. Let's just go back to, I'm sorry, I'm in long call. Might not be what you're looking for. Let's go back to long call. In the technicals, there is a field to look for number of days stocks up or down, and number of days the stock has been under, let's say an SMA 20 or an SMA 50. So let's just say I'm going to look under 70 days. No, I'm not. I'm going to clear the filters first because everything I was just looking for on the default was bullish, Fernando, so we wouldn't find any results if I put this new criteria. Let me go back to options. Let's just go 20. Here's what we're going to do. You're looking for specific stock that has a pattern. So what I'll do is I'll use either the long call or the long put to look for stocks that have a certain pattern. If I want to figure out the call or the put or the strategy later. Go to the next standard expiration, because all indexes and ETFs will expire on May 17th, 35 days away. Set your number of strikes of 1 to 1 in the long call or long put, doesn't matter which one. What I'm doing is telling the system just to show me one strike of anything that expires on standard May expiration, which will be all optionable securities, where the stock has dropped below the SMA 20 for at least the last, say, 60 days. Why 60? Because it had to drop below the 20-day first and then still continue on. I'm sorry, more than 60 days. So that's kind of like your 90 days, isn't it? Close to it. At the same time, number of days up and down, you don't want to use this. You said a consistent drop, but what do we know is that during that drawdown of 90 days, something has happened, right? What's happened? It moved up. So the minute it moves up, the stocks up and down will have corrected. You could maybe also use the SMA 20 and SMA 50. We're going to take a look at that also. And of course, just for simple kicks and grins, I want to make sure that the stock is, I'm sorry, let's just say the 90 days. Let's try SMA 100 below the 200. All right. Luck? No luck? All right, so I have 2 pages of results and neither KHC or KFT is in there. Let's check page 2. I doubt it is. These are all low-priced stocks. Okay, so all things going terrible. Just low-priced stocks with no real, nothing even above $1. All right, so that might not be it. Let's go a different way, Fernando. Anytime you have a question of, hey, what are some similar things I might see for Kraft and KHC? Well, let's go to KHC. And let's click on quotes. All right, so we're in the lower range of 4.6%, the 52-week range. Now, RSI is not going to help you. You know, I could look at the chart, say Bollinger Band. Wow, that's actually very high Bollinger Band for a stock that's been down for 90 days straight. That's starting to move up closer. Bandwidth consolidated, of course, to 20. Oh, it was lower than I thought. So the days above the stock, 50. Oh, see, it moved. It went above the 20-day moving average. That's why I wouldn't have seen it. It has recently moved back up and gone above it. So we would use 32. Let's keep that in mind. Days under, 30. Okay, we use that. And the other criteria I was looking for in addition to that was the stock. 20 is at 32.58. 50 is at 37.9. Yeah, okay, so we were below the 200. Yeah, that would have worked. Let's go back. And real quick here. Greater than 10, actually. 30. Inogen, National Beverage. Okay, so there's still only 2 pages. It's funny that KHC isn't in there. I think it would have been. The 100 was below the 200. That's strange. And KRFT should have come up as well. Let's see. I'm sorry. So that's what the one thing you do. Let's try that again. Let's do. The stock is definitely below. The 100's below the 200. And the 50's below the 100. Let me change it to 50 below 100. Did I use 20 again? I'm sorry. Let's just take a look. Let's do 50 below 100. I'm sorry. Use the 50. I'm so sorry, Fernando. Use the 50. Use about 30 to 40 days, stock below the 50. Tesla, of course, Linux, HLF. There's a lot more now. So now let's go to fundamentals real quick and KHC. Yep, there it is. Kraft Heinz is in there. It's pulled up recently, but that's what I'm going to suggest to do. Use the 50-day, not the 20. I apologize. It has a recent pull-up. That was my fault. I meant to shift it to 50 when I saw the negative 30. And at the same time, probably look for a stock where the 50-day is below the 100. Simple moving average. That, I think, will get you a link. Is Kraft now KFRT? I'm sorry, KRFT? Or is it just KFT? Oh, okay. So that one didn't come in there, but I would take a look at that. Oh, I'm sorry. Quick thing on Fernando. He says you need to scan. You need to scan for the percentage change more than 2% pre-market and pick for that. He uses a bar chart to look for stocks that are down 2% in the pre-market to look for declines. That's more of a day, not day trading. I don't want to say day trading, but that's more of what he's looking for. Let's take that out, that KFT. So KFT is not coming up. Let's take a look here. What is the symbol for KRFT? Does anyone know? Let me just look it up. I'm sorry. We'll use our little symbol look up here. We'll look for craft. I forgot the symbol. I used to trade it, but I traded the old symbol. Oh, I'm sorry. Wow. It's Friday, folks. Bear with me. KFT, Kraft Heinz. Wow. Yeah, there you go. Okay, so not even looking right. It's looking for a different stock once I saw Heinz. Okay. There you go. 50 below the 100. Try using that stock cross under the SMA 50. Or you could use the 20-day below the 50-day, but I'd stick with just the 50-day. Look for the number of days down. Start with 25 or 30. Go from there. Okay. Let's just take a look at the stock chart for Tesla. I haven't looked at it in a while. Is it 90 days down? Yeah, it's got a lot of jumps, though. Not what you're looking for, but draw a straight line down almost, right? And just say boom. You know, that's you've got a lot of potential here where it could have flipped up and down, but you could have been selling premium if you're in a long put, doing diagonal spreads at the long run-ups before a change, and hedging that too. That's one. So let's take a look at another stock that came up on that list that we might recognize. Clearwater Paper, Interdigital Comms, Pan American Silver. I didn't realize silver's been declining that much recently. Very good. Okay, so not quite 90, but about 70 days to 85. It had that run up, and then it petered, and then it's fallen, had the little hiccups. You know, nothing's constant. Herbalife. It's an interesting one, isn't it? There we go. Perfect. 1, 2 months, 2.5 months. There you go. Down you go. All right, Fernando. So that's what I think you're looking for there in the last 3 months. Of course, reverse. This was a long call screen, so we could just reverse it looking the other way, right? I want a SMA 50 above the SMA 100, a number of days above the SMA 50, at least 30. And we set our expiration to the standard expiration, 1-to-1 for the number of strikes to just get us one strike. Why just the one strike? Because I want duplicates. I don't want to see 15 insulates. I don't want to see 15 Kraft Heinz. I just want a general strike, and then now when I look at the chart, I'll decide which one I want to go with. So 1-to-1 there. Cree, bottom of our list here. Can't draw it more perfectly, can you? Right? Lower left to upper right. There you go. Not a guarantee it's going to continue, but something that's been moving in that direction, that's what you'd see. Great television. Almost did this as a married put a few years back. Oh, sorry, wrong button, folks. A few years back, 2 years, I think it kept popping up and I didn't. And then I saw it fall. There you go. Pretty decent move. Big move there, but still a pretty decent move after that Bollinger Band breakout. Had a pullback, and then it's been moving up. And it's got a little pullback now, too. Still going as well. All right. Yeah. Oh, sorry, Fernando. Absolutely. If you wanted to look for the ones that were more extended, absolutely. We could. I said start with 30 to see what you get. Then you can narrow it down further. If you went high, here's the ones that have been above for at least 70 days. Planet Fitness, of course. Knock on wood on that one. Wow. I think I got into Planet Fitness at 19 and exit my married put at 28 2 years ago, year and a half ago. Thought about getting in later when start of the new year when I saw it at 40 and didn't. It's up 48% since about January 1st, I believe, is that when I last saw it. Oh no, it was about $44, $43 per share, 46, 47. I'm sorry, 47.19 I think is when I saw it. And straight up, that's 70 days above that 20-day moving average. I would have figured that would have come in there as well. Wheat and precious metals. Former silver Wheaton, if I'm not mistaken. That one actually is in that list too. Pretty good. Gold Corp's up there. Lattice Semiconductor. That's good. I just opened a married put on a different semiconductor as well. I'll just say CPC, Cash Pilot Captain, of course, CPC, will refer to it that way. Ask, is there a way to modify those moving averages? Then when you're adjusting with Craft, I wish to scan using a close above the 8-period EMA, not SMA. We do not have the EMA data, okay? I don't have it calculated, don't have it programmed in. So right now there's no way you can change these numbers. These are just the static forms that we have, okay? If I can find a way, if we can find a way, I should say, I'll pass it off to the programmers to get a lower range EMA or SMA in, and we'll try to do that. But for right now, we're just calculating those listed, and we don't have any way that you can modify it. If you have a different charting software, of course, you saw me, we linked to Big Charts just because you can customize it the way that you want for what you're looking for. They do have the indicators, but your broker or Sam mentioned bar chart earlier, they might have a way to use EMA. So what you could do is find the stocks that have the EMA that you want, create a stock list, and then just put your stock list in here into the create and modify stock list field, and then just screen against your stocks for the option criteria you want. Little workaround. I know it'd be simpler to have everything in one page, one place, have it right here. So I'll get on that for you. I'll mention that to the programmers Monday. I might send them an email before I leave this afternoon, but I'll mention to them out on Monday. We'll see if we can get some of those EMAs in there and possibly some shorter term SMAs as well. But yes, I'll take a look at that. We'll let you know if we're going to be able to make any changes there. Okay. All right, so here we are at 5:32 p.m. Eastern Time. If anyone has any last-minute questions, go ahead and send those in. What we discussed at the beginning, of course, are ways to hedge. I'm just going to review quickly. Ways to hedge a long call position. Deni was looking at selling an out-of-the-money naked put, which essentially creates sort of a synthetic long stock position. As broker wasn't allowing to do it because it said it had infinite risk. Well, it has infinite risk to zero because you have a naked put now with a long call. So it's just like selling the naked put and taking on the same risk. Long call is not covered by that. So what did we do? We showed him a way of maybe doing an out-of-the-money bull put spread to only take maybe a 2 or 5 or 10 point difference here. So that would increase the loss, but it's capped. And at the same time, maybe even doing just with your long call, doing an out-of-the-money bear call spread where you wouldn't have to put up the margin. On the bull put you do, the bear call against the long call you don't, because your broker might just see that as a debit spread or a calendar with an extra long call. Don't need to put anything else in there as well. And Sam also mentioned instead of just converting to a strangle by buying an out-of-the-money put and keeping your long call, do a whole strangle. So you have your long call, you buy a put, and then you buy an extra long call to sort of help with that upside delta if the stock continues to move the way you want. Then we sort of got into a little bit in that line. Oh, I'm sorry, for Jim, we talked about using the search tools to find high option volume. Okay, so using that % current option volume filter in the different searches to look for options that have a higher option volume, put in a range of 200 to 300. That was first. Then we talked about the different income hedges one might consider on a long call to leave the upside open and not take infinite risk. Out of the money bull put, which would require margin, or the out of the money bear call, which would not require necessarily any other margin. You could just enter the short call first and then buy the extra long and be an extra commission, but then it would definitely show up as a diagonal spread. And then we talked about protecting JPM and structure of the proper married put to use further out in time to avoid the time decay and have a lower cost per day, but using almost that same bear call spread to generate income without capping the upside on the position. And the proper way to limit risk, whether you have an unrealized gain or you're opening a new position, and the 12 different income methods to further lower this risk to get us to that bulletproof status we saw of 12%, 10% guaranteed profit in the worst case scenario, but still having 150, 160 days to generate income and move that up even further to maybe 13%, 14% or more. That's available in the blueprint. Okay, you can check that out on the PowerOptions store, or you can check it out at radioactivetrading.com as well. Okay, and then we just finished up our other topic there related to looking for positions using the filters for technical indicators, I should say, for number of days over or under a stock cross in SMA 50 to look for positions that maybe have had an extended downturn for 40, 50, or 60 days. Okay, all right, so let's see here. Oh, that was interesting. David, is there a maximum to the watch list size? So what is he talking about there? Well, back on the main home tab, you can program different watch lists in of stocks you're trading, things that you want to view or watch at any given time. And once you create a watch list of a number of stocks, when you're in any search for any strategy and you go to the lists field, in addition to some of the default lists of IBD, Dow 30, and more, you can screen just against your watch list 1, watch list 2, 3, 4, or 5. Okay? The question is there any maximum to the watch list? I think the maximum for creating a list or having a list in the search is maybe 500 symbols per list. I'm not positive. I'll check with the programmers on that, David. And so my thought is that the watch list would have the same restriction. Now, of course, if that's in general, that the list here you want to screen against, and thus the watch list back on the main homepage would probably only be 500 lists. Of course, if I had a watch list of 500 symbols, I'd be scrolling all down the whole day trying to look at it. So honestly, if I had 500, I'd probably just put 100 into each 1, 2, 3, 4, 5. I don't watch that many stocks personally. But I will check on that with you. Now, David, even though this might max out at, say, 500 symbols for watch list 1, what you can always do is the create field, for some reason, doesn't have that. Some sort of programming mathematics. So if I had 500 in watch list 1, 500 in watch list 2, and 500 in watch list 3, sitting on 1,500 securities, if I went to the create modify lists and combined the lists, combined list 1, 2, and 3 into a master list, it would allow the 1,500 symbols in because it kind of reads them from differently. It doesn't read them as all one list. It reads them as 3 lists, so I can have technically one master list after I've created that. But I will get back to you on Monday after I talk to the programmers. Number, listings, watch list, and that as well. All right, so I want to say 500, but not positive. I'll double check on that for you and get back to you with more information. 2 comments here from Sam and Martin. Sam, I was looking at RBZ, was very volatile. I did not trade it today. It must have come up in one of the searches, and oh, I'm sorry, I got them confused. RBZ, afterwards RBZ tumbled to $11 to close as well. Okay. 585 is what you couldn't do. Okay, so I'm going to say 500 is the limit, but you could create, I'm positive you can create a list of 500 and then create another list of 85 and then combine them into a master list, and that should work perfectly fine due to the math magics. Try it this weekend. Let me know if it works, and I'll get back to you on Monday after I've talked to the programmers as well. Sorry here, let's go back. It was just Sam's comments there on RBZ. I haven't watched it recently. Said it popped up a couple of points and then it dropped roughly a oh, it's one of these stocks. Okay. Yeah, all over the map a week ago. Is that a week ago? 2 weeks ago, all over the map, and then another all over the map move today. All right. Martin, your question, I'm sorry, it got confused with another one. Let's see here, Martin, your question. Simple question. I don't know if I have a great answer. Can you do a search for when the volume is higher than the open interest? No. I don't have a filter for that. I'll check to see if I can get one in there. I'm going to talk with Ernie has some comments on that. I asked him about that 6 months ago. I think it came up, Martin. And he had a thought on that as to something to use that would be better. And it wasn't simply the put-call volume ratio or put-call open interest ratio. But he had a suggestion of to what to look for that was better, and I've got to refresh my memory on what it was. Naturally, it wasn't in the fundamentals. It wouldn't have been in the technicals. So yeah, I don't have a filter for option volume to open interest, just the put-call volume ratio, put-call open interest ratio. I'm caught off guard here, but I think Ernie suggested something is to look for something where the open interest is less than 100 and the volume is greater than maybe 101. Because if you want to see something with a relative open interest anyway, you could do it that way. But I don't think that's not going to give you all the ones you want, right? Because sometimes you're just going to have a open interest of 20 and an option volume today of 5, you know? So let me look into that, Martin, as well. The answer is no. I don't have a search for that right now. You could put the columns next to each other in the chain, customizing the option chain view, which you've probably already done. I know you know PowerOptions very well and you use it often. But I could just go into the Add Remove Columns field here, and we'll just do the current option volume and open interest, and we'll put them. We'll put them side by side. Just leave them at the end. And so now every time I run my search, you know, oh, hey, that worked, right? Interesting that those two actually worked, except for the open interest was less than 101 and the volume was higher. So that kind of did it. I know there's more out there that have it, but that kind of did it. Let's do the same thing, but cut it in half. It's for an open interest less than 50 and an option volume today of greater than 51. All right. Let's bulk it up. 1,000. 1,001. They didn't fit because the open interest was less than 50. It was greater than 50 for those two. So let's go 1,001. Those are the type of options you like to look at. Walt Disney, that doesn't surprise me. An open interest of 616 for the July 19, 135 call. We're in long call, right? Yep. And volume today of 1,082. Let's take a look. I'm curious about some, just on the call side, because I'm in a long call search, so it's already limited to just showing me the calls. Okay, here's another one that would have come. Oh, yeah, that's the one that did come up. Oh, I didn't change the expiration. That's why. I'm still forcing it to be 75 to 150. I knew there'd be other Disney ones that came up. The reason they didn't come up is this. There's the one. All of these here do, of course, but they're all today's expiration. All right, so that's another thing you want to keep in mind when you're searching is what expiration you're looking for as well in that case, Martin. But that might be a start. If you wanted to look for something that had a higher open interest, sorry, folks, that's what I'm looking at right here. Let me just highlight it. Just like I had in the search, I've got my current option volume to open interest. I don't look for that specifically. I look for a basic number. I mean, geez, biggest ratio here was today at the 129 strike and at the 130 strike, which makes a lot of sense. But let's go out to that June series real quick. While we're here, let's take a look at that June series in our call chain. Why? We had one pop up, but that's because I didn't clear out the other criteria. And yeah, see, that one that popped up looks like it was the only one, isn't it? This is lower. This is lower. Good jump in volume, don't get me wrong, but those were all lower. These were the only two that were higher, and I had restricted it to be no more than 2 strikes out of the money. So only the 135 came up, Martin, but it did find what I needed, but I was looking at least 75 days out. So yeah, those other 3 Disneys didn't quite exceed their open interest, but our 135 and the 140 did. The 140 didn't come up in the search because of my restriction on the number of strikes out of the money. Yep, less than 1. So take that out and still look for activity, something with at least 1,000 open interest and more volume. There's your 140. Curious, Martin, let's do this while we're here. So what have I done? I'm saying that maybe you want some good volume to begin with, or good open interest of maybe around that 1,000 range or 700. So we just look for open interest less than 1,000. What are you missing? Things like JP Morgan and Bank of America that might have a 15,000 open interest. They do, believe it or not. They're huge. But let's just take this out, and let's just go to standard May expiration. And so everything with at least about, just around a good range of open interest, with the exception of this Disney, which had none for its day. What are we dominated by? JP Morgan, Starbucks. Ooh, interesting. I'm at a Starbucks collar right now that's a guaranteed profit of 5% and a max profit of 8%. But that's for next week. But that gives me an interesting outlook, doesn't it? 82.5, 3,839 contracts today, open interest of 185. That looks interesting. Oh, wow. Big volume on the S&P 500, 306, May 17th strike. 269, almost tenfold volume into open interest. Same with the VIX short-term ETF call. Ooh, must have hit a target buy because it dropped, yeah. And then Hess, it's an interesting one too. Pretty interesting companies there. Not a recommendation or a suggestion, but that's interesting. With the run today JPM, you expect that, but seeing Starbucks and seeing Hess. Well, thank you, Mark. This is not something I normally trade on, but I'm curious to see oh, sorry, wrong button. I didn't want the option research. I want to see the stock research. I want to see if earnings came out on Hess recently or if they're coming out. 425. Interesting volume to open interest there, huh? 328 to 1906 on the at the money 17th of May expiration, 2 weeks after the earnings. Neat. All right. So, but that's the starting point, Martin, as well. Oh, yeah. So, yeah, you were talking about Nigerian's little thing, the heat map there as well. So, and that's what I use sort of the percent option volume for that we looked at earlier. That's usually a good notation of where we are as far as ones that would match that activity as well. Okay. All right. Okay, here we go. All right. Let's see. CPC, actually, with this, I can't. He just asked, could you make something that's a little bigger for the cursor-wise, going over this like a red dot? I can highlight things, but once I change it, I can't click. So the only way to do it is with that clicker on the go to web format. Just reads on my screen as well. Okay. All right. All right, Martin. So you have everything at your disposal that you kind of want, except for that one thing. You had talked about the 1,000 here. You talked about how to look for the ones that have that activity. We sort of showed how to search, and they said they want less than 21 days. Change your criteria to whatever you want. All expirations less than 21 days, and you said short-term ATM or OTM. Restrict your range out of the money. Got all the tools there to do it. Now that you know that you could do it this way, not exactly what you want. I'll check on that and get back to you there, and we'll go from there. Yeah, and SPX came up here. Yeah, there's that SPX one. It would have, if it was, oh, let's just run it. I'm here. I didn't restrict the out of the money range. At or out? Oh, sorry. There you go. So that narrowed it down to a few. And, the ones you'd expect to see. All the banks. That Starbucks one again. Also strong movement. 5 below. Very interesting. Well, Disney, of course, Walmart. I'll go to page 2 very quickly while we're here. There's all your S&Ps. Okay. And it's not fair. I should change this. I don't know if you do this, Martin. I would recommend changing this. I'd put it at least 10. There's a lot of SPYs that actually had zero open interest in huge volume today with the move. Random strikes popping up 293.5. Is that even necessary to have a 50-point strike difference on SPY? but I put in some there so the good ones come up. You know, at least 800 open interest, your 293 strike for April 24th expiration, the 295 as well. Okay. Sam has an interesting point I didn't catch. 2 days ago, Kramer said to buy Disney before the analyst meeting was yesterday and before they announced the streaming service. He was correct, but I'm sure he did not anticipate this move. Okay. I'm sure he'll also kind of be talking about that today, of course, of how right he was. So, and I would too. I would toot my own horn if I'd done something like that and caught that before. All right. Well, ladies and gentlemen, I think that about does it for today's presentation at 5:50 p.m. Eastern Time. I do not see any other comments that have come in or questions. I just want to remind you all, of course, that today's material are my thoughts on your questions, your criteria, and the approach I might use for some of your potential trades, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. Yes, I showed interest in some of the things that Martin's search pulled up, but I tell you what, I'm going to have to test that for a while to see if that's a good approach as well. Real quick offshoot. Okay, Martin asked this last question. I'm just going to say any stocks or options discussed today and any stocks or options I'm going to discuss in the next 10 seconds should not be taken as direct trading suggestions. Options involve risk and may not be suitable for all investors. On that note, Martin's question, last minute question that came in, is it reasonable to play the VIX to the upside when it goes below 12? Absolutely, in my opinion, and that is just my opinion. And when I see the VIX go below 12, that's typically when I am buying calls. Okay. I had mentioned earlier in the presentation, I do not know if you were here, but I had mentioned to Sam that I had bought calls when I saw, I was just setting up the field here. I bought calls on the VIX when I saw it drop to 13 from where it was. And I thought that was a good time. And it did show some small profit, and then I got out of it with a small loss when it started to reverse. It was only a 21-day cycle here. So it was back at this point. Let's see here. I would have been pulled down below 13 here. Yeah, I got in here, middle of March. Maybe a little bit higher, but I saw the peak here at about 16. It started to pull back. I actually closed them here for a small loss, didn't buy back in, would have been break even here. Okay, not enough movement. But right now with it at 12, see, because normally for me, that's what I would do, Martin. And when we saw it months and months ago, last year, January and February 2018, when it was dropping below 11 or it dropped below 10, I got extremely lucky because in January 2018, I bought calls on the VIX, not expecting what was going to happen February 5th through 9th. That return on those 8 or so VIX calls that I had made up for the loss I had on my 3 bull put spreads on February 5th to 9th with that volatility crush when we saw everything just collapse downward. But that was then. And so here, you see that the average here is actually hovering around 20. And so it dropped. So when I saw it at 13, I thought that was the new low because that's where it was before. And it went up to 16. And I was right. I just didn't catch it in time. So here, absolutely. I think this is a great time to buy calls and VIX with no more than perhaps 2% of your total portfolio or 3% of your total portfolio. You don't want to put that much in. Okay, why just a call though? What call am I buying? I'm going a few strikes out of the money right now, probably to the 16, maybe to the 18. I'm probably going 45 days at a time. May might be too close. Believe it or not, I don't know what's going to happen next. But my whole purchase into the VIX would not probably be more than 2 to 3% of my total portfolio. Why just a long call? Why complicate it with a debit spread or anything else? I'm waiting for just what if, and the VIX spikes back up to 20. These things skyrocket to a 300%. That's all I'm doing. And it's not for profit. It is for hedging my portfolio. Okay, that's it. I don't, yeah, Martin says, hey, you could do a ratio spread of 12, 3/14s. I'm sorry, sell a 12, buy 3/14s, buy 1/15. My apologies. Sell 112, buy 3/14, sell 1/15, 35 days out. Net debit 75 cents. I'd probably be buying 4 or 5/16s. contract size, and just leave it at that. Honestly, and make that 2% of my portfolio. Not complicating it with any obligations of sell or buy, even though I have it completely hedged and covered, Martin. That's me personally. Okay. 1,000 ways to do it. Martin's absolutely right. There's 1,000 ways to do it. And as Sam always mentions, he's a big fan of, he trades the UVXY up and down and around. Not something I particularly do, but that's what I look at. But hey, if your ratio is working for you, Martin, that's great. I just like to stay with just a standard. I've got 50% of my portfolio protected with the radioactive trades. Then I've got bull put spreads, calendar spreads, and some other strategies that don't have that protection. How do I protect that part of my portfolio from something like February 5th to 9th if it happens again, or last year March 21st to April 5th, October 5th? That's where I'm just buying VIX calls. Your structure's good. Gives you a low debit, still gives you that infinite for the pop. You're absolutely right. You got 3 in the middle, 2 on the outsides. You've got 1 long call, but you've hedged the cost of the other 3 long calls as well. It's a good approach. Leaves your upside open. It's great. I just like to keep it simple for this part of my portfolio. But you're right. That's a way to do it. A sort of butterfly ratio hedge. I'm going to show it for people who are interested. Now I mentioned real quick, I might be going out to May or further. I don't know if I'd go to June. I'd probably go to June, but let's keep with just May. All right. And it's 33 days away because it expires on Wednesday. Remember, the VIX expire on Wednesday. And you said sell a 12, buy 3 13s, buy a 14, right? Okay. Good stuff. Good stuff. All right. And your debit was 7. I used the wrong expiration. I'm sorry. That's okay, though. What is the 13 long call? It's at 208. What's the out of the money 14? 146. Okay. So here is a debit. This isn't the structure you wanted, I don't think. You were using a different expiration, so it was a lower price. You said 85 cents, I think. So that's good. But here's the structure. So it's a limited risk here. The worst case is if it's right at the long strikes. You hedged it a little bit. You still have the infinite upside if it goes above 14, 15, 16. Break even of 1482. In this scenario, not great. Max exposure, 282. And that's in that worst case scenario. I'm going to say your real max exposure is 182. Okay. Yeah, it could end up right at 13. That's a good possibility. It could end up in this. Sorry, Cease. I should do that here. It could more likely end up in this range if the market waffles for a while. But let's say your real risk is just around 200. 182 to 200, not the full 282. That only happens at one particular instant in that case. And so you've got a total outlay of 4 contracts, sold 1 for a hedge, sold 1 for a hedge, bought 1 in. Good to go. Okay, now your upside's open for that spike. That's a beautiful thing. Why? Because he's got 3 calls. He's got a bull call debit spread 12 to 13. That would get that extra $1. A bear call at 13.14, which he might lose that $1, and then the 1 extra 13 call, which he hedged the cost on instead of it being 622. Total cost only 181. Why is the risk at 282 if it's trading right here? Because of the structure. That's all. Okay, the monetary requirement of the bear call spread is what it's looking at there. Okay, so now 33 days out, right? That's what we were looking at. Oh, it's so tough. With the midpoints, I'm buying the 16. It's not scientific for what I do, and I apologize for that. But as a hedge, what do I typically look for? I look for the one that's $1. And at the midpoint here, the 15's too expensive. So I would just buy this, and I'd buy as many contracts as represent maybe 2% of my total portfolio. My break even is ridiculous compared to Martin's, right? We saw Martin's was at about, his break even was, what was that, 1382, I think 1482. Mine's going to be at 1684. But the key to remember is the VIX does not always perform price-wise as you think a normal option does. All right. What do I mean by that? Let's just go out 19 days. Now this is a bid ask. I'm sorry. The VIX right now is at 12 even. Oh, this is pretty close. Oh, here you go. This is a better example. It's at 12 even. It's been declining, so the 13 put is priced at 38 to 65. Shouldn't it be at least $1? That's not how the VIX works. You don't get $1 premium until you're, I'm sorry, $1 premium until you're 2 points in the money. Okay, but the calls are overpriced because it's been declining. All right, so Martin's structure has benefits. Martin's structure has the benefit of still having the upside open, but not paying that exuberant cost for that at the money 13 strike, which would cost me $2.80, was it? Oh, I'm sorry, 167. Oh, that's May 1st. Sorry, guys and girls, ladies and gentlemen, I should say. Yeah, there we go. 13 was at that, $2.210. So instead of paying that, I'm paying $1 up here, but that increases my break even. But hey, when the VIX breaks, the VIX breaks. If it goes up to 20, I'm going to be at a profit, and Martin's going to be at a great profit as well. So it's just two different ways to cut a sword, his pros and cons of each. Okay. All right. So oh, there we go. Okay, so I just wanted to look at that. I like the idea, Martin. It's a real good process there as well. I just want to remind everyone, showcasing the tools today, that fantastic insurance tool to lock in a gain on JPM that we looked at and still see ways to generate income. Search capabilities that we reviewed today, multiple ways to do searches, looking for different trends, high option volume, even a way to maybe create a little screen for open interest that's lower than the current volume today. We saw that. Any of those tools interest you, remember, anytime, just go to PowerOp.com, put in your first name, last name, and email address, have full use for the tools for 14 days. After that, subscription starts at $40 per month. Most popular one is our delayed service, usually a 20-minute delayed service at about $60 per month. But we do offer the real-time service as well and access to the historical data, which does go back to April of 2006. So it's about over 13 years of data. Historical data. Want to check out some other free education this weekend or at any time? You can check us out on our blog, blog.powerop.com. You can go to that webinars page at any time, powerop.com/webinars.asp. Today's presentation will be archived and likely posted on Monday, if not before. You can always check us out on YouTube as well. Just scroll through various ones. If you do think of any questions you had about the discussion for today's presentation, what we saw today, remember you can send me an email to support@powerop.com. And of course, if you had further questions about that married put approach, the blueprint, the full manual for limit risk trading, locking in guaranteed profits on an unrealized gain, and 12 different ways to adjust that to cancel all of the risk further bulletproof the position and generate income, email me to support@radioactivetrading.com or go to radioactivetrading.com and check out the blueprint. All right, well, ladies and gentlemen, oh, okay, Sam asked a question. What if the market goes up? I think SPY will break to its previous high of 195. Don't know how long it will last. It might tank. Very true. However, the long call, remember, is a hedge in a sense that, the VIX calls are a hedge in the sense that in case stuff. Okay. So the idea is that, hey, I might go a month or two with spending two cycles, maybe 80 days, spending 2% of my total portfolio value for the in case stuff happens. And if those VIX calls expire and I don't sell any other calls or VIX puts against them to hedge it, I'm okay with maybe taking that 2% loss because that meant that the rest of my portfolio was doing much better than 2% with the other positions in my portfolio. So I'm okay with that. But when it does go wrong and my other positions that aren't protected in the married put structure start to see a loss, I've got the VIX calls to hedge those as well. All right. So thank you everyone for joining me today. Have a fantastic weekend. We will see you next week, one way or the other, a couple live webinars next week. And again, our Friday session, of course, because it's going to be standard expiration April 19th. So we want to make sure. No, I am sorry. We will not be here on April 19th. It's Good Friday. I will not be available April 19th. I will not be available next week. Maybe we'll have a discussion at the end of market on Thursday. That is a good point. I forgot about that. Remember, everyone, your options expire on Thursday this week, not on Friday. Markets close on Friday due to Good Friday. So we have to do everything by Thursday at 4 o'clock. I had forgotten that. Now I remembered it. Now we're good. All right, take care, everyone. We'll see you next week. Good night.